Hey everyone, Cotton Candy TA here, and welcome to Beginner's Course Part 8, Timeframes. Alright, if you're enjoying the content so far and haven't followed the channel yet, go ahead and do so, subscribe, click the thumbs up on the videos, and if you have any comments or questions, please feel free to leave them. If you want to support what I do and donate, you can find the details in the description on the video below, and if you haven't checked out the TradingView account or the Twitter, I would recommend you do so, as I post up some charts there that you guys can follow along with, my content release schedule, and just some different day-to-day stuff that I'm doing in the trading world. Alright, without further ado, let's get to it. Okay, what are timeframes? So quickly, just to identify for those of you who may not know, timeframes are represented by these candlesticks. Okay, I'm on the monthly chart right now. You can have weekly, daily, 12-hour, whatever you choose to use. Basically, the way this works is each candlestick here represents your time frame. So if I'm on the 12-hour chart, this candlestick represents the last 12 hours of price movement. The next one would represent those 12 hours and so forth. If I'm on a weekly chart, that would then switch over, and each candlestick would represent 1 week of action, or the weekly time frame. So just to identify for those of you who don't know how it works, that's what timeframes are. Okay, let's go back here. Okay, why are timeframes important to levels? Timeframes are important to levels because they denote the strength of the level. Now, before we go any further, I'm going to just make a quick mention here. There is a lot to know about timeframes. Timeframes are a very basic concept, but hard to master. Timeframes become very important on every trade you make for two reasons. I'm not going to get into all of the timeframes and their implications in this video. Reason number one is there wouldn't be enough length in terms of the amount of time I like to keep this content limited to. Number two, the start of timeframes versus the end of timeframes and everything in between is a vast amount of information. People just learning about timeframes aren't going to be able to grasp from A to Z, right? There's a marquee of practice that you need in there to follow along with some of the more advanced concepts of timeframes and what it means when they break and things like that. So there's still going to be very valuable information in here, and there's still going to be a lot of advanced stuff in this lesson in part 8, but just not all of it, because that will be for an advanced course. Okay, so how are timeframes important to levels? Timeframes are important to levels because they show you the strength of a level. So, for example, I always use silver for my monthly levels. If I was to just mark out some levels here, right? So this would be a monthly level, okay? And this up here, the swing high, would be a monthly level. And the bottom of the swing high would be a monthly level. Just to mark out these 3 levels to start, okay? Let's talk about that for a second. From the day of its inception on what am I on here? Binance. From the day of its inception, when it first came on Binance, it took 2 months to form this level and 3 months to form these. So it took 3 months to form these 3 levels. Now, if we were to switch this over to a 12-hour time frame, okay, and we were to go to that same beginning of the coin's introduction into Binance, we would have much more levels, right? So we are going to, for example, just now I don't use yellow as my 12-hour, but I'm just going to use it for this example. We are going to use yellow as the 12-hour time frame. We'd have the swing low here, right? We'd have the high of the swing low, which is right here. We would have the top of the swing high. We'd have the bottom of the swing high, and so forth as you go on throughout all the moves, right? As you go on through your chart. Now, if we were to switch back to the monthly, those 12-hour time frames do not have the same strength. It's only taken 12 hours to develop that level, or the series of 12-hour candles that lead up to it. Maybe, I don't know, maybe it was 10 12-hour candles, which is 5 days. It only took 5 days to make those levels instead of possibly taking 2 months or 3 months or 6 months or whatever it is. So there's a level strength that comes with these time frames, and that level strength is very important to start wrapping your mind around how these time frames that are creating different levels of strength based on how long it took to create that level, right? So obviously a 15-minute level is going to be weaker, if you want to put it in those terms, weaker or stronger. It's going to be weaker than a 4-hour level. It's going to be weaker than a 1-hour level. It's even going to be weaker than a 30-minute level. Now, not all time frames are relevant However, the point being is that a 15-minute is going to be weaker than everything above it. Just like an hour is going to be stronger than a 15-minute, but then weaker than everything above it, and so forth. So it's really important to understand that these levels that are created with time frames, they come with a certain strength. And for that reason, when we chart out any chart, and we're going to go through this in this example, in this course part 8, as you chart out anything, you always start with the higher time frames first. So anytime I'm charting levels or anything in general, I am charting them from the month down. So I'm using monthly first, right? I'm using this first. Then I'm using weekly levels. After that, I'm only using daily levels when I see it fit and necessary. And we'll go over that. Okay. So why are timeframes important to trades? Timeframes are important to trades because they will show you the breaking point, and they will, and this is going to be the half of the course that goes into the more advanced topics and how and why and when they break, and the things that we won't be discussing in this, but we are going to touch on them, right? And why are timeframes important to trades? Timeframes are important to trades again because without those time frames, you cannot see the strength of the level you are facing. If you are on a 15-minute time frame, you're not going to do some kind of crazy swing trade to break a monthly level. It's not possible. It is under some circumstances, but 95% of the time, it's not possible for a 15-minute time frame to all of a sudden break a monthly level. A 15-minute time frame is going to break an hourly level. It may test a 4-hour level, right? There's a formula as to which time frame is capable of breaking which level, right? And the ratio and what that exists. Now, that's not discussed in this lesson, but it will be discussed in the future. But again, the purpose of this is to start practicing seeing time frames, because this is very valuable. You need to, in your guys' charting, in your guys' TA, and everything you do, you guys need to be avidly looking at these levels and saying, that's a monthly level, that's a weekly level, that's a daily level, that's a 15-minute level, and start observing the interactions that each level have with the time frame and the strength. And keep in mind that if you're in a 15-minute level, are you going to go up and touch a monthly level? No, probably not. And if you do, what does that mean, right? Is it the first time you've touched it in a 4-hour cycle? If it's the first time you've touched in a 4-hour cycle, which is the first time you've touched on a daily, you're not all of a sudden going to touch it and then 30 minutes later retrace a little bit and go right through it. Because if you think about that for a second, if we were right here, right? Oh, let's turn the magnet tool off. That one always gets me. Let's not talk about it. Let's find a point here, somewhere where something has touched, and we've only really identified 3 levels right now, so it's not really important, right? If we, okay, this is kind of just the first thing I saw. If we are looking at these 15-minute time frames, right, and we are looking at this, and we are right here, and let's zoom in further. Let's get this nice and tight, okay? And we are looking at this, and we know the silver line is a monthly level, and we have just touched this on a 15-minute time frame. Are we all of a sudden going to lose this level and continuously move down? No, let's think about that for a second. This is only happening in a 1-hour period. And in this 1-hour period, it's only happening in a 4-hour period. So let's just switch this to a 4-hour period, right? What happened in, whoops. What happened on that circle on that 4-hour period that we did? You see what happened in that 4-hour period? We touched down and we held a level. We are not going to all of a sudden in a 15-minute chart just smash down and lose a level, right? It's going to take time, right? Patience. So a 15-minute level is not going to go and break a monthly level. An hourly level is not going to go and break a monthly level. And you guys need to start spotting this out, right? This may look in here like this was, oh, we lost a level, this and that. Oh, look at all of a sudden we have a monthly test on an hourly level. But if we were to switch that to the daily, let's see how it looks. Where is our red circle? Oh, we're over here. That's why. You see, actually on the daily, it was just a touch and a rejection, and then the next day we came down and we moved back up because this is only a span of 3 days, right? So a 15-minute isn't going to lose a monthly level. It's going to take multiple attempts on the daily like this. One attempt here, come down, close up, test again. And this, you know, if you start to look at this, trying this attempt to break this monthly level, this is happening over 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, I don't know, 18 days, something like that, right? Let's swap it over the weekly. Whoops, another little trading boo-boo. Well, actually, look at it on the weekly now, right? We didn't even close under this monthly level. We didn't even have a candle close under it. We just kind of tested the level, right? And kind of developed this one attempt break, kind of followed by this uptrend here, right? We kind of just created that. So realize that a 15-minute level is going to have a certain respect and a certain bounds it lives in, okay? So that's why it's important. Okay. Oh, one more. Let's get rid of that guy. So that's why it's important to understand why timeframes are important to levels. Now, timeframes are important to trades for a couple different reasons. And I've made a chart here that I'm going to scroll down and we're going to look at after I chart this out. But I'm going to walk through this. I'm going to walk through charting this out and how I would chart this completely to start training your eye so that you guys can follow along, because we've learned about levels, we've learned about trends, we've learned about values, we've learned about, you know, all those things up to this point. And if you haven't seen that material yet, videos 1 through 7, I would highly recommend you go through that material and learn it. Because everything leading up to this point, you're going to have a great foundation and understanding of videos 1 through 7. And if you need to watch them 4 or 5 times each, do it, because most people do, because they're very context rich, context rich in their content, or content rich in their context. I maybe both. I don't know. Doesn't matter. So to illustrate level strength and to start training you guys to be able to implement these level strengths and these time frames on your own, we are going to go through this step by step and how I chart something from having nothing on a chart all the way to seeing what's going on in the current. And this is very crucial to timeframes, because you guys are going to understand and start to see as I'm charting this. You're gonna follow along and you're gonna watch this. And we're using Monero in this example. XMR BTC is a ticker. You guys are going to see how the timeframes are developed and what's respected and what's not, and why these timeframes are existing. So let's start by charting this out. My monthly levels are always silver, so make sure my magnet tool is on. Take it off sometimes, put it on. Yeah, it's a little frustrating, but we are going to start with our first swing low. Always ignoring the first candle, just like I've said in previous videos, just because there's too much volatility on the open of a first candle. It's not a candle I use. So we have the swing low, right? There's really no swing low in this move, or sorry, I should say there's a swing low, but there's no high of the swing low in this move, because there was no downwards movement. It just moved up. So this is one of the exclusions where you don't have the top of a level or the top of your swing as a level, right? So let's start by getting the swing low. Then we get the swing high and the bottom of the swing high, right? So that's our first 3 levels. Going through this, we have the bottom of our first swing low right here. Okay, and then this is not going to be a swing high because it's between 2 levels. It's not a new swing high, right? There's a swing high here that tested this level. So this is it for the level right here. As we go down, we have our candle low and our high of that swing low. So those are our monthly levels defined. And then we would have the swing high of this level, and that's it so far. So that's your monthly levels defined. Now, another reason we do this is because as we're charting, if you were to chart the weekly first and then the monthly, you are going to see a lot of overlap, and you're going to end up deleting weekly levels and saying, okay, this isn't making sense. Why is this here? Why is that there? And then it's going to be pretty blaringly obvious that you've entered weekly levels first, which is wrong. You want to start with the highest time frames. Okay, now we go back and we start identifying the weekly levels. Okay, so weekly levels for me are always purple. So let's set that before we do anything. So we have the swing low, that's already identified. We have the top of that swing low, which we actually have now here on a weekly level. So we actually did have a top of that swing low, it just wasn't on the monthly, okay? So we have the bottom, we have the top. We have this comes up here, swing high, right? We have this here is the swing low of that high, which is another level right there, you can see it, okay? As this moves up, this is not a level, and that's exactly what I was just explaining, is that this would be a swing low before the new move up. But look at, if I were to put this level here, look what's happening. The level's actually a monthly right there. It's not a swing low weekly. Now, this would have been established prior to this level being established. So if we were to go and do this and take this portion out, that would have never existed. So you can mark this as a swing low, but then you're just going to delete it once the monthly comes in, right? Once you have, no, come on, step through the move. The replayer is being a little weird. It's going a little slow here. There it is. As you did this, I wonder why it's doing that. It's being a little weird. Oh, because it's developing the weekly. I see. So as you did this, that would have become the swing high. So you wouldn't need to have, you would have deleted this at that point, you know, but because we have the chart history, we can just delete it now. So continuing on, we have the swing high here. We have the swing low here on the weekly, okay? We have this comes down here. This is the swing low before the move up. So that's a weekly level, right? We have the top side of this. That's a weekly level. This swing high here actually tests this. So that's not a swing high because that's a monthly level. And this right here would be, okay? So then all these levels here, these are just tests of current levels. So the swing low here ends up being a monthly level. We don't need that. And then this ends up being a level right here on the weekly chart. And the bottom is not, as its proximity to this swing low is just a test of this, right? It's still living within this bound, so it's okay. We can continue. The swing high is not a level, as it's just testing this, and that's something that you guys have to use your own discretion for. There's a certain amount of space. If we look at this here, we have to expand this. 22,500 and 25,600. I don't know why I said that. I said it weird. Tongue twister for me. 25,610 versus 25,811. It is too close in proximity to be a new level. All it is doing is testing this level here, okay? As we come down, swing low, it's testing this weekly. The swing high is that monthly. The bottom of this is also not a level, as it's just testing this monthly. So we have a monthly here, a monthly there, right? My cat's making some noise. Let's continue on, right? We have swing low here, top side of this as a weekly, right? Wait a second, let's make sure this is correct. Swing low is actually this candle right here. And this is the weekly swing low. So this is kind of an interesting one because you have a swing low point here on a candle that's actually got an up move. Which makes it say that although this is a swing low right here, and the high of this candle is a swing high, and the high of this candle is also a level 2. We will get into that more in an advanced topic because that is an inclusion of one of these concepts, because it's all, you have 2 swing lows in one move. So without getting too far into that, just follow along for now. We have this swing high here. This swing low is a test of this level here. It doesn't quite test that level. This is another case where your level is just too close to the monthly, right? This is a failed test on the monthly. This is a failed first touch on the monthly. You have your swing low level right here. And that's the weekly levels. Now, some of these weekly levels, like this, do not exist. Okay, I wanted to identify those first and then delete them after to show you something. This does not exist. This does not exist right now. These 2 weekly levels exist. This does not. These are going to then be daily levels. Okay. And as we go into the daily levels down here, we can see that this is not a level. So this is kind of a process that you're going to go through. And this is why you chart out the monthly levels first, because you will see that as you break it down further, you will see where it's actually not a level. It's just a test of something else. So this weekly actually wasn't a weekly level. It was a test of this monthly. So this can be deleted, right? That's not a level. This was a test of this monthly, right? You have the move down. It comes up, tests it again before it breaks, okay? This is a level, right? This is coming up, it tests it here. Now let's start identifying some of these daily levels. And we are going to start from the start of this move. Now, the reason we are only putting daily levels here, a lot of people ask me, well, why aren't we doing daily levels in this whole entire area here? And there's a very specific reason that has to do with time frames, okay? The reason we are not doing that, the reason we are not doing that is that, now, before we identify daily levels, because you need to know why we're identifying these daily levels, we are going to look for the valley that started this. Let's look at the monthly. There's no valley on the monthly. Let's look at the weekly. There is a valley on the weekly. So this valley is identified by the move that started this down to that low right there and this close over here. Now, there is a weekly valley here. This is very important to know. All right, you can see if we switch back to the monthly, there's no monthly valley. This isn't a valley on the monthly. This is just either accumulation or distribution, right? Not going to dive too far into that. If we go to the daily, right, we can see that this valley, the first spot of this valley, and this has to do with time frames, right? The first spot of this valley, okay, it is on the weekly. You can see the valley forming here, and originally the valley would have been like this, right? Just like we talked about in the last lesson, the valley would have been something like that. It broke through the valley and it actually took a move down. So then this wedge, valley wedge, call it whatever you want, this wedge then gets expanded further, right? Because we broke down. Just same concept and principle we learned about in the last video, right? So we're just taking the bottom side of that, right? We're lining it up and we are taking this valley and we are creating it like that. So this is a weekly valley. So important to know that if my default color, usually when I do these valleys in my videos, and I've done it like this so far for a very specific reason, I've used white because it's just a neutral color. From this point on, I will be using the color code of the valley spotted out. And what that means is if my weekly levels are purple, my valley here is going to be purple. So that ties into your time frames concept that you need to know. Right? If you could only have spotted this on the daily, right? If this was only seeable on the daily, I would be putting my valley to red because red is my daily levels, right? I would be identifying this valley as red. Instead, because of time frame theory, I'm identifying this valley as purple, which is important because you need to know not only the strength of levels, but the strengths of valleys, which are also levels, right? Because they are just trend lines. This is just a trend line of the hard left edge right here. And we're going to line this up perfectly on the daily and then swap it back to the weekly, right? And you can see here, Monero is respecting this hard edge trend line, this valley that it's created, it's respecting, but it's first viewable on the weekly, right? You can identify a valley on the weekly, which is very important. Okay. You can't identify this on a monthly. You can't, it's not enough time frame. You can identify a monthly valley here on this, right? You can identify this silver valley. If I was going to color it, you could identify this valley here because it's had enough time to build this valley, right? You would be able to then go, you'd be able to then go like this and change this one to silver, and that would be a monthly valley. But that's not what we're talking about in this video, and we're not there. We're looking at this move right here, this weekly valley. Okay, so important to know that as we look at these time frames, right, we are only starting the daily from this valley. We don't need to chart out daily levels up in here. We don't need to know anything that's outside of this valley, right? Whoops, let's delete that. We don't need to chart any of the daily levels. Oh, again, it's being funny. We don't need to chart any of the daily levels in here. We need to chart the daily levels that are in the valley to see what's happening in the current move. We are testing to break out of this valley. So this time frame, we are going to take the weeks that it takes to test outside of this valley, and hopefully we're going to ride this trend line of this valley all the way up, right? But this is not a 15-minute chart, so it's not going to happen in 15 minutes. We're not going to do something like this, right? We're not going to do something like that straight up. It's not realistic. This is a value that's been created over how many weeks? Let's count, because this all factors in the strength of levels, and valleys and trend lines are levels too. Remember that. So let's look at this now. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. We have been in this valley for 19 weeks. We are not going to break it in an hour. We're not going to break it in 2 hours. We're going to make moves over days. And this is where this concept gets important. We are going to make moves over days. This day we're going to conquer or fail this level. That day we're going to conquer or fail that level, right? So you guys need to start spotting this out. And that's why we are only using daily levels right now. So let's start to identify daily levels within this wedge. Okay. So we're going to start here. Monthly level. Okay, we're going to start here. We go down, we touch the monthly level, we come up. This is a daily level, right? That's a daily level. Oh, let's put the magnet tool back on. Top side of that, bottom side of that. That's a daily level. We can see we immediately broke out and we came and tested that level again. Let's keep going. Is it here? Right there. Nope, we're not done yet. We haven't seen a swing low. Oh yeah, we have right there. Swing low right here. Top side of this is a level. The bottom side is not. And the reason the bottom side is not a level is because it's testing this weekly, right? This is not a level because it's testing the weekly. So that's important to know that within these moves, this is not a level because it's testing the weekly, right? We've got the bottom side of this, and we've got the top side of that candle there. Okay. As we go down, this is a test of the weekly, or this actually might be the creation of, or sorry, not the weekly, the monthly. This might be the creation of the monthly. Regardless of if this is the creation or not, we know that's a level, and we've seen the daily test right there. So those aren't levels. Okay. Swing down is not done. So this is a daily level down here. And the top of this is a daily level as well. Okay, let's continue moving on through this move. Swing high right there, that's a level. We know the bottom touch is a monthly level from previous, so we can keep going. The swing high of this is a test of this daily. So it's important to start looking at this and seeing where the tests are and where they aren't, right? This right here is a test of this, so it's not a new daily level. And this swing low is not a level either, okay? This is the level right here, the swing low on the move. That is the level right there, and the top of this swing low is a test of that previous level. Okay, we come up, we see that this is the test of a level right there. So we come up, we go over that level. This is not a level either, right? You don't have a third level here. You have a test of this level right here. This is not a new level despite what this candle looks like. It's not a new level. This was a test of this level, right? And then we have the monthly form there, okay? Swing low down here. This is swing low as a level, but the top is not, because the top is a test of the monthly. Okay, as we go down, test, test, tests. This is not a level. Is it? Sometimes it gets hard to see. I don't think that's a level. No, that's not a level. The swing low was right here. That's right. It's not a level because the swing low is here, and the top side of this is just the test of the weekly level. Right, we go up. That's not a level because it's touching that daily. The bottom side of this would be a level, right? Top side is just a test of that. And it looks like that is it. This is a failed touch of that. So now you can see as we step through this move, right? Now let's break it down into a 4-hour chart. We can see what's happening. So now you can start to understand why the daily level is so important, why the weekly and the monthly level is so important, and why time frame you chart down, because you can now see what's going to happen in the intermediate of this coin. And now you now have an understanding of your chart as here's where the monthly levels are, there's where the weekly levels are, there's where the daily levels are, and here's where the target lies. So let's just kind of step through this move a little bit at a time. Okay, and we're just going to start from here. We just pick an arbitrary spot. It doesn't really, we'll start from here. Okay, so we got a weekly level here, right? Oops, magnet again. Thing always gets me. Okay, we're just going to start right here just because it's what's on our screen. Okay, we have a test down of the weekly level. Obviously, weekly level's been established right here, right? So then we have a test up of this daily level. We reject and come back down and establish first touch of this weekly level. 90% of the time, first touch is going to reject. As we've talked about, we can now see as this coin is moving up every 4 hours. Now remember, this is a 4-hour chart, so it might look like there's a lot of levels on here, but this is going to describe exactly what this move is doing, right? And how time frames are going to show you the importance of these moves, right? So now we come up back over this monthly level because we never really lost the monthly level. We kind of just got weekly level established and then we moved back up over the monthly level. We never actually lost this monthly level. We would have had to go way down to lose it. So then we come up and we establish a daily swing high here. We know red is our daily. Come down, take first touch, which is always going to be rejection 90% of the time. There's a small window in there where it can go through based on other criteria, but we know 90% of the time first touch is going to reject. We come down, right? 90% of the time first touch is also going to reject. Remember, we came up over this move here, right? First touch up, first touch down, first test break. Right now we've touched and tested this monthly level in the past. We're not going to go further back in this chart, right? We would have actually had to break this monthly level to gain this as a level, which is very important. We would have had to wick over that to gain this. Remember, we talked about that in the levels video. We would have actually had to wick the monthly level to gain that. So we never actually wicked it. So we never actually gained it. Important to know for the future. Now, I don't know what this is going to look like in the future. Like I said, I do all this stuff on the fly. So that's why sometimes I'm charting like this and you guys see it and you're like, oh, why does he look confused? Because I'm figuring it out as I go and I'm charting it as I go because I don't pre-chart this stuff. I just do it on the fly. So then we can see monthly level goes up and over, comes down, touches the daily, comes up here, tests a daily level from the past, wherever that is. Okay, so that was identified way back here somewhere. Right there it was identified, right? We come up and we push past that level here. Don't quite get to our weekly target and come down, create a new monthly level, bounce off, or a new daily level, sorry, bounce off that daily level, come up, break the weekly. Now let's think about this for a second. If we are breaking this weekly, okay, it means that we just gained this weekly down here. So this is now gained support. This was actually never lost. So we actually didn't gain it. It was never lost. It was established and never lost. When we wick past this level, it's going to give us the momentum to test the monthly level, right? It's not going to give the momentum. Breaking a weekly level is not going to give the momentum to test the daily level. And that's why you notice in this 4-hour span right here, when we wick past this weekly level, and we've got a weekly level down here, when we wick past this, we actually test 2 daily levels right within that 4-hour window, right? So that's a perfect example of why time frames are so important, because you have, if you did this to it, if this was a daily level, if this purple line was a daily level, you probably would have just stopped short right there, right? You wouldn't have wicked 2 daily levels in the same 4-hour window. That could have been a 15-minute window that happened. I'm not sure, I haven't broken this move down, but this could have been 15 minutes possibly. What we know right now, based on what we're looking at, is it's in one 4-hour chart, we not only wicked a weekly level, but that gave us some momentum to wick 2 daily levels. At that point, breaking this weekly level, so time frame theory, that's an important level to break. What will we do next? We will test a monthly level, and we establish a monthly level right there, right? So I think that's where we establish the monthly level. So we break two daily levels, we establish a monthly level. We come back down, we test. Let's verify that. But that was I'm pretty sure that established the level. Yeah, so that established the ending of that move right there. So in that time period, that was, let's go back and take a look. This was the final 4, 8, 12. This was the final 12 hours before the month. So now that's another important thing to realize there too, is this was at the end of a month. So No, it wasn't at the end of the month. It was at the beginning of the month. Okay, so in this case, this was at the beginning of the month, and at the beginning of the month, this 4/8/12, that established the full month's monthly high. So that's another important piece to know, is that this is establishing the monthly high right at the beginning of the month. And you'll see that a lot of the times at the end of the month and the beginning of the month, which also comes into time frame theory as well, because you're going to see large moves at the end of a day, at the end of a week cycle, at the end of a month cycle. So, and opposite to the beginning, because it's setting a tone for the current month or the next month. So that's also another important thing to know when you guys are charting and looking at these things. Take note to which day it is. It has more significance if these moves are happening at the end of the month. So if this is happening on the 27th and you're seeing a move form, this has more significance than if it happens on the 15th. Just because that's ending a monthly chart. So that move is going to tell you more. More about that in a future, my famous saying, more about that in a future video. But I wanted to open your minds right now to the concept of what day of the week it is. If this is happening on a Sunday afternoon and that's the end of a week chart, start looking for that and spotting it out. Is this happening at the end of a day? Is a 1 hour candle doing something at the end of the day? Is a daily candle doing something at the end of a week? Is a weekly candle doing something at the end of a month or at the beginning of these time frames as well? So just keep that in mind as we go through this course, that I want you guys to start looking at the days in which these moves happen. Okay. So moving on through this move, we go down, we test this daily level, come down here, we then break this weekly level, right? We then come back down from this weekly level, which means what? If we're losing a weekly level, time frame theory dictates that our next target, right, if we were going to get re-entry, should be at a monthly level, right? Because we're losing a weekly, the strength relativity to that is not that we broke a weekly, a daily is going to offset us completely. It might take up to a monthly level to offset us. Okay, and remember, we are all still within this weekly wedge that's happening. So as we go, we touch down to the daily level, we come up, we try to regain that, we get rejection off the daily, come down, and ultimately after this dance, what do we do after we lose this level? We end up testing the monthly, just as I said we would, right? We end up losing the weekly level, right? Or wicking past it, I should say, breaking it. We don't lose it until we actually wick this. We don't lose that until we wick that weekly. But we lose this level here, right? We break the level. We don't lose it, we break it, which is, closing out of it. So then what happens? We touch our monthly level, which is the same thing that happened over here. We break a weekly level, we establish a monthly level. We break the weekly level here, we touch the monthly level. So time frame relativity and strength, right? So understanding what these time frames mean and the relative strength of these moves. Okay, so we come up, we touch the weekly, we kind of go through this dance, right? Go back and forth, and we're just gonna kind of speed this up because we're dragging this out a bit, maybe to where we are now, and we bounce between levels and do all this stuff here, and you guys can see that the levels are being respected all the way through. You've got two levels here that it's kind of struggling to stay in between. You've got, this channel that it stays in here until it loses, it loses this, and then it goes into its next channel, which is here. And then we have kind of the identifying closing of this wedge, right? This weekly wedge. So let's look at this. When we are in this right here, we are now starting to test the time theory on this wedge, right? Remember, we have a weekly wedge here. So let's scroll into this. We have a weekly wedge here. We now are going to do one of two things. We are going to continue. Oops. Oh, we definitely don't want the arrow. That's not what I wanted at all. We are going to continue testing this wedge as support, right? We're going to continuously bounce off it and come up until we can either, close out of this wedge, or we're going to move sideways and move down, right? Either one, you have to realize that this is not going to happen in 15 minutes. And what's going to happen next? We're not going to dissect that, but what we are going to talk about is this, right? Time frame relativity. Take a look at this. We are not going to take a rapid move down off this wedge that's being created, that's been created over the course of whatever it was we said, 18 weeks or whatever, we are not going to break this in one 15-minute move. It's going to take multiple attempts, multiple breaks, and this is on a 15-minute chart. And what does that mean for the 4-hour chart? You know, what is this, 40 tests in there? What is that on a 4-hour chart? Like, how many tests, right? Count all these moves as tests, right? Or just start from here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 tests and it's not breaking. Let's go to the daily, right? You can call all these tests because this is the trend line. I just have it drawn improperly. 1, 2, 3, 4, 5, 6, 7. 7 daily tests, right? Well, what is that on a weekly? This is a weekly wedge. Remember that. How many weeks have we tested this, right? We came here. We tested it once. We've tested it twice. Now, let's use time frame relativity with some of the stuff we learned about levels, right? This right here, first touch, we know that's rejecting. This move up was bound to happen, right? That's first touch right there, 90% of the time, that's rejecting. This is first test off this valley or this wedge. And actually, let's do something else here. Let's do that. So something I want you guys to see here. I drew a trend line there, even though we're in a valley. We're in a valley on the daily, right? We can clearly see that this valley is being pulled up like that. But on a weekly, we have this other trend that's going on. Now, on this trend right here, this is establishment of the trend. This tool's being funny. Let's try to circle it a little larger. It's TradingView's tools are they're a little funny sometimes. Okay, we have the first swing right here. We have the establishment of that trend line. We have first touch right here. This is first touch on the weekly chart. When this comes down next and tests this, right? If this comes down and tests it, I would expect it to break on the next touch if it touches again on this chart. Okay, because this was established as the swing low, beginning of trend, first touch. Next is going to be first test. So if on the weekly we break out of this, I fully expect momentum to come and touch this level here to potentially break it, because we are getting rejection out of this wedge. We are going to move sideways straight out of this wedge, and then I would fully expect it to break this, as we've already established first test right here, right? We've already established, or sorry, first touch. We are now going into first test, which means it has the potential to break. Off this first touch here on the weekly, we should expect a pretty wild move up. It's not a 15-minute first touch. It's not an hourly first touch. This is a weekly first touch off a weekly trend. So that's very important to know that this was expected to be a rampant move up, right? And look how violent that move was, right? Because it's time frame relativity, because the time frame is dictating the strength of the move. It's dictating the strength of the rejection, of the offset. It dictates everything that we have learned in the past. It dictates levels. It dictates movement. It dictates volume. If this is happening on a 15-minute chart, there's only so much that the move can happen on a 15-minute chart. Let's go look at where I circled on the 15-minute. Well, holy crap, those are huge zones. Right? So this was the beginning of that wild move up. And look at how many candlesticks. I don't know how, that's a long time. This is October 28th all the way to where it's swung up November 4th. So this is a pretty, that's a week. So this is a week of 15-minute candles, right? So time frame relativity, right? Don't expect you to... This is starting to look pretty bad here. Let's delete some of this. I'm pretty anal when it comes to my charts and how clean they look. Don't expect first touch, right? Don't expect this right here to be a wild move up on a 15-minute chart. So have that in your mind, that you need to start seeing levels versus time, right? The strength of time and what that means when you're in the moment. Okay, and we're going to leave it at that, because I can go on with this for quite some time, and this is already a pretty long recording, and this is why we couldn't discuss, and we have one more pretty cool thing to go over. This is why we couldn't discuss all of time frame in one video, because the amount of information that there is with time frames, I could be talking about this for 2 to 3 hours. So we're going to leave it at that, and you guys can see as this move goes out and as we follow this move, the relativity to strength of levels and why time frames are important. Okay, now the last thing. This is a really important piece, and this is pretty cool. This is a chart I created, and not all to my credit. I've taken small pieces off other charts, and I've created half of it, and I've used my own ratios and my own formula. But this is kind of a common chart like this. Wonder if I can have a highlighter tool. I can't. So I'm just going to say this entry on, so this column here, and this chart levels and this hour period. This is like common knowledge, but I have my own formula that I use. Just things that I've tweaked that make more sense than kind of the generic stuff that's on there. And you know, I have hours on mine, so mine's a little more elaborate than what you find online about these charts and what they look like. But this is my formula, and what I found to be pretty bang on. My ratios, my hours in each day, and the trades and all those things. So the information, the inputs, I guess you would call it. The inputs are my own inputs, but this chart is a common used template. I guess it's the best way to put it. I don't know how else to put it. So, okay, time frames. Now this kind of comes important too with time frames, and I want you guys to follow where my mouse is. So we're going to talk about the type of trader, and this is where we're going to start. And the way you use this chart, and you guys feel free to use this, you know, screenshot it, whatever, copy it, you know, use it. I took the time to make it and build it out way back when, get some use out of it. So this is going to be what type of trader you are. You're either going to be a scalper, a day trader, a swing trader, or a position trader, or you could be all the above. I am all four. I have positions in every category. I don't limit myself to just one or two or three or four. To me, I like to be a well-rounded trader in all. So if you are doing scalp trades and you are entering based on 15-minute candles, so entry on is based on what you're entering. And you're using chart levels, right? So the chart levels, this is an hourly ratio, 4:1. So if you're entering in a 15-minute chart, which means, we're going to go back to this. If you are looking at a 15-minute entry, if you are watching charts on the 15-minute and looking, let's just pick some, I don't know, some arbitrary spot. Let's just go with right here. If you are looking at this chart, right, and we're just going to pick right here. This is the move up, okay? And we're just going to pick yellow for 15-minute move. If you were moving up, right, and you saw, okay, this is the top of that swing high and this is the bottom. The top we already know is a daily level, so let's just use the bottom is going to be probably the most relevant entry because we know the daily level is there, so we don't need to mark that out. If you are using a 15-minute chart, you are going to swap over to the hourly. You are going to map out your 15, right? And you are going, oops, I don't want to move the wedge. I just want to find where I put my yellow line. You are going to move to the hourly, and the first touch on that hourly is where you are going to take your position, okay? So that's how you use this chart. Does that make sense? I hope it does. It's very brief, but I'm on a 15-minute chart, and I'm looking at this move, and I see it tops out right here, okay? I see it tops out right here, and this is the zone that it's fighting for in that 15-minute chart, and I've identified that if this move was right here, right? I've identified that at this point. I've identified that this is the move up, and that's the level before we're going to see what it does next, whether it continues to go up or down, and this is the bottom of that swing low, and the top is a daily level. I am going to then switch over to my hourly chart, and I am going to make my decision based on what's happening on the hourly. Where are we here? Wait a second. Did TradingView just make an error? It did. What the heck? Oh, I have to cut it back when you swap over here. It loses where you cut the where you cut your chart. So it would have been right here. That's odd. It would have been right here that the chart got cut. Okay, so I've now identified that this is target and this is where it's fighting for. So whatever happens on the hourly chart is where you're taking your position. Oh, shoot. No, wrong button. So if you are trading on the hourly chart, right? We got that there. Speed up another hour. That is where you would have taken position based on the type of trader you are. So let's go back and look at this for a second. We mark out the 15-minute chart. We take position based on hourly touches, and we are holding for 6 hours maximum. that is what we are doing. That is called a scalper. Okay, so let's see how this plays out over 6 hours. Now, this isn't saying at hour 6, take exit. You have to identify your own exit targets and your stop losses and all those things. But to define this as a scalp trade, if you are entering based on 15-minute charts, you don't want to be in this for more than 6 hours. Now, there is exclusions. A move can be still up, but if you're scalp trading, proper identification says that you are not holding this more than 6 hours, right? So let's see. So this is 1, 2, 3. You might have taken exit here, right? Probably not. You probably would have at least liked to see the test of the level or the bottom touch of this. For the first touch of either of these levels, you probably would have taken exit. 4, 5. So that's actually where you would have taken exit, would have been up here or at some level. 5, 6. Okay. So at the 6th hour, maximum time frame says that you should 1, 2, 3, 4, 5, 6. That's where you should have exited if you're scalp trading. Went down after that, retested that level. So on the 6th hour, actually, that would have been a perfect trade. 1, 2, 3, 4, 5, 6. You would have exited here on the second test of this level, and then you actually probably would have rebought here and done another 6-hour stretch. 1, 2, 3, 4, 5. Okay, so maybe you would have 6. Okay, and then so you would have actually exited on the exact same level. So that's pretty cool. I'm actually kind of I'm kind of happy it happened like that. I just picked this random spot, but you can see like the scalp trading. What happened. I'm just curious. We're gonna do 6 more hours. I don't know what the heck's gonna happen here, but this is very cool. 1. Don't tell me it's gonna go down. 2, 3, 4, 5. Don't do it. 6. Okay, so it wasn't like 100%. It actually tried to test this level and got rejected. But on that I use a 6-to-1 ratio because I found through the years of using the 6-to-1 ratio, that's how scalps work best. And this is kind of the way it looks like usually on scalps as you go through these 6-hour windows, and your kind of best results are limited to a 3 to 6 hour window. A lot of people do only 4 hours, but you know, I like to extend it to 6 because there's been a lot of times when I haven't quite done 6 hours, and yeah. And then after the first 6-hour stretch, that was actually kind of your high point. You actually could have got better entry, but 1, 2, 3. I'm just keeping on going to this. 4, 5, 6. So that would have been entry there. 1, 2, 3. Probably would have exited there. 4, 5, 6. Yeah, it would have exited on the level there. I'm not going to keep going. I've proved my point as to why I use a 6-to-1 ratio. That was just kind of cool. It worked out that way. And then how many hours a day does that take? That takes 4 to 6 hours daily to do that. So the hours you're going to spend, if you are a scalper, you are spending 4 to 16 hours every day in front of your trading screen. And there's nothing wrong with that. That was insane profits there. I don't know how much that was. Geez, let's take a look at that for a second. How much were the profits in this thing from here to here? And how many times did we do it? Oh, magnet tool, please. One of these days, me and you are going to fight. So this would have been for a scalper, 2.5% each time. And we had 1, 2, 3. So you would have gotten 7.5%. You would have gotten 7.5% on using that ratio by identifying levels correctly. So using that ratio of 6 hours, identifying levels correctly, you can see time frame is also a science. Just like everything else, time frame is a science. So like I said, feel free to copy my chart and do as you please. And as a scalp trader, you are going to spend an absorbent amount of time daily charting. So if you want to be a scalp trader, be prepared to spend 4 to 16 hours every single day in front of your computer, right? If you are just a scalp trader. Now, I'm going to get into my formula in a few minutes here after I go through this. As a day trader, you're spending 2 to 6 hours daily. You're looking for entry on the hourly, just like we did with the 15-minute. You're just adjusting it to the hourly, and you're looking at 4-hour chart levels, and you're only holding for 3 days, and that's a day trader. And then as a swing trader, you're 2 per trade. 2 hours per trade, and you're doing this often, and you're entering on the 4-hour chart, and you are using a 6-to-1 ratio. So you're using a daily chart level, the 6-to-1 ratio here. I actually made a mistake on this. This should be 6-to-1 as well. I don't know why I typed 4-to-1. These should actually all be 6-to-1. They are not 4-to-1 ratio. They are a 6-to-1 ratio. All of these. I'm going to edit that right now. So this is 6-to-1, and this is also 6-to-1. Close. Okay, perfect. So this is actually 6-1, and this is 6-1, and I didn't mention 4-1 because I know this off by heart as 6-1. But I use 6-1, not 4-1. Sorry for that mistake. So daily as well. So if you break out your 4 hours, 4 times 6 is 24, which equals a daily chart level, which you're holding that coin for a total of 1 to 7 days. That's a swing trader. And hours on a position trader, you know, is 4 hours per trade. And the reason why it's more than a swing trader is because you are taking less position. So you want to make sure that you are you're spending more time on the chart to take a better position because you are looking for a long position. Now, a position trader can be somebody who holds a coin for 5 days. It can be somebody who holds a coin for 4 months. It can be somebody who holds a coin for 2 years. A position trader, and I just put 1 to 1,000 as kind of a, you know, broad so that you can see it's not 1,000 days max. It could be 10 years, right? So you can see why taking 4 hours per trade on a chart is more important and valuable, and you're not doing that often. So you might take 4 hours twice a week. So you might have an 8-hour work week if you're a position trader. Now, it's not, position traders aren't making a day-to-day income. They are making large incremental gains on large periods of time. So with that said, you understand the hours that you need to put in daily and why you would need to put those in. You need 2 to 6 hours daily on a day trader because you're entering different types of positions, right? So this is the chart to use. Now, I myself personally am all of the above. I am a scalper, I am a day trader, I'm a swing and position trader because I see different positions that I like to take in every single type of trade. I have position trade longs that I do see something and I say, this is a good opportunity for a long. This is at the beginning of its down move. And I'm going to show you an example of what position trading would look like, right? We're not going to do a position trade, but I will show you an example of where I may have entered on a position trade and where my exit may have been. Let's just click auto, get this thing sorted. Move this, get rid of this guy, get rid of that guy. I just want to get rid of these red lines and all this other stuff that's not needed. These yellow lines don't need. It's my anal self being that person. Oops, that I need. Sorry guys, I can't do this without doing this. It's just a little thing. Even that hidden one, I got to get them all. It's like Pokemon, got to catch them all. Terrible joke. Okay, so a position trade for me would have been a long entry. So I know this is a monthly low. As this came through, I would not have been buying this candle. But on that monthly, as soon as this rejected, I would have been taking a long position somewhere in here. As I got confirmation that this level is holding, I would have taken a long position here, and my long position would look to exit here, the start of this valley. So the start of this downtrend, what I know this valley is going to be in the future, I would not have taken exit here on the first wedge of this. Like, right, you had 2 wedges in here. You have one right here, right? I would not have taken exit somewhere at these levels. My exit is here. So I wait, and maybe I end up waiting 6 months. This is a position trade, right? Maybe I end up waiting 6 months, and that's okay too. But my exit on this position trade is this, and I am studying this position trade in great depth, and I'm waiting a long time for it to happen. I might wait 3 weeks to take a position. I might say, you know, I've identified this level, right? We might be on the weekly. Oh, we are on the weekly chart. Okay, so that's perfect. We're already here. We might be here, and I say, okay, I've seen this as breaking. We're in week 1. Week 2, I see it's holding. Week 3, we bounced off it. I'm taking entry right there on week 3. And, you know, it might take me 3 weeks to get into this trade. But once I see that confirmation, I'm taking that trade for a position trade, right? Or maybe my strategy for this was a scalp and I just, or some other kind of trade. But for me, this is how I would identify a position trade. So I have spots where I'm identifying these trades, right? And then going back to this list, I have spots where I'm identifying the same thing for everything. Swing trades, where I'm saying I'm in one right now for MTL. I'm in a swing trade right now for MTL, where I've planned it out and I've been in it for about 6 days now, and I'm expecting it to break up, right? We won't get into that, but I'm in a swing trade right now on 1 or 2 coins, as well as a position trade on some other coins, as well as I'm day trading other coins and scalping. So for me, I like to do all of these things. So you guys decide what type of trader you want to be. There is no right or wrong. For me, I like a hybrid model of all of them because I have different ideas as to why and different expertise as to where I'm entering what coin and why. So I hope this is a great first lesson for you guys on levels and the way they work and why they are so important, and time frame, the theory and the idea of time frame in general, and how strong that can be, right? Let's just go over this one last time, make sure we covered everything. What are time frames? Well, I think you guys know by now. Time frames are important to levels, covered that. Why are time frames important to trades, and the chart for trading. So yeah, like I said, use this chart if you want, screen capture it, do whatever you need to do. And I hope you guys enjoyed this lesson. Go ahead and follow the channel, give it a thumbs up, donate if you want to support, all that good stuff I talked about at the beginning of the video. And this has been a great lesson, Beginner's Course Part 8, Time Frames. See you guys on the next one.